Let's bring in a guest who has been waiting patiently through all this, probably champing at the bit. It is, I believe it is champing, not chomping.
Not
People
chomping?
say chomping, but it's champing.
Yeah.
Chris Harvey, Wells Fargo. Chris, thank you. You heard our discussion. I'm not going to ask you to slam the Fed or agree with the Fed, but no matter how good earnings may come in over the next couple of weeks, how good the guidance is, will the Fed still matter more, or have we gotten to the point where now everybody knows what the Fed's going to do, earnings will make or break this market?
Yeah, I don't think earnings make or break the market. What earnings do is they start a rally, and it's just a trading rally. As you pointed out before, it's a rent not own type situation. What the Fed does is the market doesn't stop going down, or we don't make a bottom until something breaks in the capital markets and the Fed pivots, or earnings come down not 2, 3, 4, 5%, but 10%. So we're still just sitting in front of things that are yet to unfold. And what we're looking at is just the cost of capital has gone higher. Fundamentals are still okay. They'll get worse, and that's the problem.
What do you mean something till something breaks?
Well, if you look over, you talked about the UK. If you look over the UK, it looked like the pound was going to break. It looked like the euro is also down, right? It could be a collapse of a currency. It could be a collapse of sentiment. It could be something in the Ukraine.
What about just
Anything.
inflation going down?
Inflation, I think inflation is going down, and I think if you were ever going to use a transitory word, you would use it right here, right now. A year ago, we were saying, I've never seen prices as high as this. People were coming in and demand twice as high. People were raising prices 5, 10, 15%, and people were saying, I'll take 2, I'll take 3. Now they're saying, whoa, wait a minute. I'm not going to pay that for that, right? And so now's the time where inflation does come down. What I think we need to worry about more is why are we stuck on this 2% inflation rate? Is 3 or 4, as long as it's stable, is that the right rate? And maybe that is, but I'm not sure we're going to have that conversation just yet.
But if you think about inflation and goods inflation and then the services side of the inflation, if we say all the time that we need to see unemployment and whatever that level is, that the Fed isn't going to say it outright, but it's probably north of 5%. That's really the inflation to worry about, isn't it? Because this is a consumer that at this point is making more money and in some sense is able to ride out this storm.
Right. I think it's a difference between the inflation the Fed sees and the inflation that you and I see. Right? The Fed sees something, hey, CPI isn't cracking. CPI is plateauing around 6%. We need to get it down. We need our credibility back. We have to get it down. But when you and I look at things, what you see is a situation where the underlying fundamentals are starting to roll over, that the things that are going to pull down inflation are rolling over, whether it's interest rates, whether it's demand, whether it's the supply chain. So at the end of the day, inflation is going to come down. How quickly is a big question, and the way the Fed reacts to it is more important.
So, Chris, when you think about what Brian was just saying before, like people got lured in, they were buying things, whether it was crypto or NFTs or SPACs. I mean, the list goes on, or unprofitable tech companies that have recently gone public. A lot of the air has come out of that. I think we can all agree that that trade is kind of done. And when we're talking about the broader markets, you look at the S&P 500 and you say down 22%. That's not so bad. Right. Do you think of the market as a monolith, as equities across different spectrums? Is there a way that if the average decline of the S&P 500 in the post-World War era was about 35% during a recession, let's say we are in a recession at some point, do we have to go down 35%?
The answer is no, we don't have to go down 10, 15, 5%. Well, but until the Fed pivots, what's happening now? The cost of capital is going higher. So there's a duration trade. That's pushing prices down. That's pushing stock prices down. More importantly, we haven't gotten to the fundamentals rolling over. Now the fundamentals have to roll over. I think we are going into a recession. I think numbers do have to come down. Until that occurs, we're not going to wash things out. Can you make money? Yes, you can make money renting things, not owning things. Can you make money in certain sectors?
What are we renting then?
So one of the things we've been talking about to our clients is momentum. Now, it's nothing exciting. It's nothing really sophisticated, but it's things that are working. Stocks that are working, sectors that are working will continue to work. What you want to do is you also want to avoid things that are broken. You don't want to go bottom fishing. You don't want to be contrarian. You're not getting paid for it. And you just have to have this very simple approach. Chart looks good, chart looks bad. I know it sounds really simple.
Oil and gas looks good.
Oil and gas does look good. And that's, if you look at the momentum index, oil and gas is a big part of the momentum index.
There you go. Chris Harvey, Wells Fargo. Thank you. Kind of shooting from the hip here. Appreciate it. Guy, let's talk about this. I mean, Dan referenced the average drop in the S&P during the recession, I think, is about 35%. I saw some data today that the average time the S&P goes down is 318 days. That's an average. Doesn't mean it's going to be shorter. That's the average, rather. We're day maybe 290 of the decline on the S&P 500. Does it feel like, I'm not saying call a bottom, but does it feel like we're kind of getting closer to the end than the beginning?
Well, I know there's an answer for that question. That was deep, by the way. And just let me address Dan quickly before I answer that. The fallout can be measured in the market. Yeah, it's not a big deal, 25%, 30%. What you can't measure in terms of the fallout of this reckless Fed is what's done to the lower and middle class who got screwed on the way in and are now getting royally screwed on the way out with inflation. They don't win here. The wealthy people win on both sides, number one. Number two, yeah, I'm not going to be one of these to call bottom. I think, due it's a tradable level, and what we're seeing now is eerily reminiscent of what we saw in June. And I think this is one of those bear market bounces. But the math suggests, and the math being $200 worth of earnings, maybe 210 with a 15 or so multiple, that we're probably staring anywhere between 3,200 and 3,400 in the eyes in terms of the S&P 500.